Hi and welcome to this MF Corner special. I'm Pavitra Parekh and today we're going to talk all about passive investing. Now in the last few years, we've seen this segment really gain a lot of market share from just 1.4% of the total AUM in 2015. Today we stand at over 17%. If you look at the assets under management, there's been an 8.5 times rise that we've seen in just 5 years at a staggering 54% CAGR. So to discuss this rise in popularity and how best to really plan your investments when looking at passives, I have with me just the person. Anil Ghelani is Head of Passive Investments at DSP Investment Managers and joins me now to really discuss this space. Anil, it's always a pleasure to have you on the show. So thank you so much for taking out the time and speaking with me today. First up, on this big rise that we've seen, what do you think has brought about this increase in popularity? And where do you think we could be headed in, say another 5 years from now, just in terms of the total AUM share?
You put down the data very perfectly. Like about 5 years back, it was very small fraction.
Yeah.
2-3 reasons that I believe are responsible for this sharp growth. Point number one is that no doubt there is a lot of awareness in the markets now. People are watching global markets and seeing in some of the other countries, like for example in the US or in Europe region, where passive investments like ETFs and index funds are picking up. So people are wanting to experiment and try it out. Second point is that people are also concerned about the performance that the active funds are delivering vis-a-vis the underlying index. Now for that, I believe it's a cycle. So in certain periods, most of the active funds, especially I would believe in the large cap space, were finding it difficult to beat the benchmark. And that's when many people said that, okay, then in that case, let me allocate some component of my investment portfolio into passives. So that resulted into a little bit of a spur in the adoption of passive funds. Maybe in the next cycle, now in the next maybe 1 or 2 years, we could see that part reverse also to a certain extent, whereby some actively managed funds will start seeing good performance and beat the benchmark. But structurally, over a cycle, I believe people are getting very much aware that yes, there is a need for having passive funds as a part of my overall portfolio allocation. It helps in reducing the overall cost. And I believe very strongly one of the key drivers has been the simplicity.
Yeah.
So apart from the performance, cost to a certain extent, very often that comes up. But one key thing is simplicity. When you are talking to new to mutual fund investing or new to equity market investing, it becomes very strong point to showcase the simplicity of this product without having to worry about the investor getting confused on certain overperformance or underperformance. So I feel that is a key aspect. And considering the rise, like what you mentioned in the next 3 to 5 years, I would say that currently how we have seen about 16 to 17% of the entire mutual fund industry of 47 lakh crores is into ETFs and index funds. I feel when we come to 2028, means let's say about 5 years from now, this number would have risen to at least around 25 to 30%. So with the overall growth of the mutual fund industry, like there is a MFI report which had come out during 2019 that by 2029 means like total around $100 trillion will be the size. So if we look at that kind of a number, I would feel anywhere between 25 to 30% will be the share of the ETFs and index funds.
Okay, so even though we've seen a big rise in popularity, it's only set to go up even from here as, investor awareness also keeps increasing. And Anil, I'm glad you brought up the point on large caps because it is true, right, that in large cap funds, fund managers have a hard time sort of beating the index because of the rules as well. You cannot construct your portfolio in a certain way, even though the index is constructed in that way. But moving on now, within the passive space, do you think you've seen a bigger rise in mid-cap, small-cap passive funds? I'll come to the micro-caps later, or even these sector funds. You're seeing so many, nifty IT funds. Do you think there's more interest in that? We've seen a lot of NFO launches.
Yes, and I think, I'm not sure, but maybe you're referring to our slew of recent NFOs also, which we did. And yes, definitely there is a growing interest in not just sector funds, but I would say in different building blocks of the overall market. So how I see is that investors as well as advisors gradually will move to the position where they want to use these building blocks to express their investment view. So suppose, for example, if I have a strong positive view on, let's say, for example, public sector undertakings, or within that, let's say, there is some view which I have holding that public sector banks will do well in the next, let's say, 12 to 18 months. If I invest into a broad plain vanilla, let's say Nifty 50 ETF or index fund, or into any actively managed funds, no doubt over there also the fund manager would have taken some allocation and give me exposure to the PSUs and PSU banks. But to showcase my that investment view, maybe I would like to select, let's say, a Nifty PSU bank ETF, which will be exactly aligned with my that investment view, and I can see it play out in the full manner that I have envisaged. So definitely there has been a growing interest for such building blocks. Let's say, for example, IT, PSU bank, segment of only private banks, or let's say a segment of only healthcare stocks, a segment of only, let's say, certain component of mid caps. Let's say within that, I want to focus on quality as a factor, or small caps. So definitely we are seeing an increase in these kind of small building blocks. I would like to highlight, however, Pavitra, that here the size of these funds yet is gradually growing, because that kind of a grip on the underlying and taking that call is gradually happening with very good investors and advisors allocating over there. So no doubt at this point of time, few of the fund houses have launched these products. AUM or assets in these funds will gradually grow.
Okay, got that. That is on, these individual pockets which are also seeing a lot of these passive funds being launched. Anil, coming now to, how would you really recommend someone pick between an index fund and an ETF, right? In a place like the US, it's kind of a bit of an obvious choice because of the taxation. In India, that's not the case. So if an investor wants to get into passives, how do you recommend they pick, between index funds and ETFs?
Superb question. And I like it always you connect the whole dots, global markets, local markets. You're right, Pavitra, that in India, there is no tax incentive or benefit for either of them. Index fund ETFs are treated at par. I would believe both of them offer similar risk and return outcomes to you as an investor. Only difference is how you want to invest and hold that allocation. So for example, if you are used to having a trading account and a broking and demat account, and every day you are investing into stocks and capital markets, maybe ETF is better suited for you, because in ETF you can get intraday pricing, hold the securities in a demat form, enter or exit based via your standard broking platform wherever you are used to investing on a day-to-day basis. But suppose if you are a investor who does not have a broking account, who does not trade regularly, including people like us who are experts in capital markets, but we have certain restrictions whereby we don't end up having access to broking accounts and trading accounts. Like that, there are many such category of investors who don't have permissions to open broking account. So for them, index fund is a better alternative, where you can not get intraday pricing, but you still get the day and NAV. You don't need to open a demat account to hold that security. So it's a on a lighter side. Just like think of it, you want to book a taxi and come to your office for this interview. I had a choice to, let's say, book a taxi on a mobile app using my fancy GPS tracker. I'll just press the 1 or 2 buttons and my cab will be booked and take me over there. Or there was another option that there was a phone call based taxi. I would make a phone call, say, this is my location, come and pick me up. In both, my outcome will be same. A chauffeur driven air conditioned car will come to my office step and drop me at your office. But the structure or the construct is different, whereby you are getting, let's say in ETF, easy access intraday pricing through your demat account, and in index you're not. And then some small things, suppose if you want to do a SIP, in index fund it's a little bit more convenient. In ETF, of course, now most of the digital online brokers offer SIPs even in ETFs, but still some of those facilities are a little bit more convenient in index fund. So net, both are equal in terms of risk and return outcome for you. It just depends on your convenience based on these few factors we just discussed.
Okay, that really breaks it up and makes it very easy for our viewers to understand. Anil, one more question is that, if someone has decided that they want to look at a simple Nifty index fund, how do they pick? Because there are so many available. So is there a checklist that, you would have? Do you look at the fund house? Do you look at the, expenses that the fund is charging you? What would you really suggest in terms of a checklist here?
See, as I said, like structurally, the risk and return outcome for the product will remain same whether you buy Nifty ETF or Nifty index fund of XYZ fund house or ABC fund house. Over the period, I like to think of like 5 key points, when about how to select one particular index fund over the other. First and foremost, try to look at the way in which that fund house has a serious effort into the passive investment industry. So small questions like, does the fund house have a dedicated investment desk for handling ETFs and index funds, so that when your allocation comes, they have a dedicated focus and dedicated fund managers and dealers. Second, let us look at how the fund house is going to be doing the ongoing servicing and reporting to you in terms of, let's say, regular account statements, in terms of day-to-day or timely basis reporting of the portfolio valuation, etc. Third is the ease of transaction. Suppose you want to buy a index fund, whether you have a branch of that fund house close to your home or office, or does that fund house offer very seamless and easy online mode of application through their web portal or their mobile app, so whether that kind of a ease of and comfort of doing the transaction, regular servicing and support is being available to you or not. And then fourth point, if you go into a little bit more technical aspect of the underlying portfolio, then you should look at the tracking error and tracking difference of that particular portfolio and see the history. So if some of these points have fallen in place, let's say there is a dedicated team, by and large, one would expect that the fund will have lower tracking error, and tracking difference, which is a simple gap between the fund return and the underlying benchmark return. That is something which you can very easily see and compare basically amongst the other funds and make your choice. And the fifth, of course, structurally is the expense ratio, like you mentioned. So sometimes I feel that even if there is a low cost product, all ETFs and index funds typically are in the similar range of low cost. But still, if you see a meaningful gap, if the gap is, let's say, 3, 4, 5 basis point plus minus, I think it's by and large okay. Because these other 4 points, if they are meeting your comfort and the criteria, then few basis point of expense is not going to matter too much. But all else being said, if there is a reasonable gap in terms of the expense ratio, then I would like to suggest that yes, go for the fund with the lower expense ratio. And last, overall, sometimes people go a little bit on this aspect of size. So after these 5 points which I mentioned, dedicated investment team, ongoing servicing and comfort, ease of platform, tracking error, tracking difference and cost, size I feel in passive funds should not be considered. Because as long as your underlying is large, liquid and transparent, like in this example, Pavitra, you mentioned that I want to buy Nifty index. So Nifty index underlying 50 stocks, we know that they are large, liquid and transparent, all three. So then the size of the fund which you are investing has less relevance, because what the fund manager is doing, that just becomes a layer or a wrapper and is going out and buying the underlying 50 stocks. So as long as your underlying is LLT, large, liquid, transparent, I strongly recommend to investors as well as distribution the advisors, that you don't need to worry about the size. So this is how I have my checklist of 5 points, and the 6th overall point of not looking at something not to look at basically.
All right, Anil, that is very, very helpful. So thank you so much for explaining to us, everything that you should keep in mind, because sometimes it can become a little intimidating, right? When you have so many options, you're just getting into the markets. So thank you for breaking that down and telling us exactly how to approach the passives. With that, we're going to wind down on this very special edition of MF Corner, where we discussed all about passives. Thank you for tuning in, and we'll be back very soon with lots more.